Good morning, everybody. It is December 14th. Happy Monday to you. Happy holidays to you. Got another market update I wanted to share with you all. So I hope you get something of it that it's used to you. So let's get started. Let's jump right into it with a quote. Buyers and sellers quickly jumped back in the market this week after taking a break during election week, according to Realtor.com's weekly housing reports for the week ending November 14th. They're talking about the election. We saw a little bit of a dip in home sale activity through the election. Maybe folks putting their hands in their pockets saying, we just want to wait and see how this turns out. Can't really blame them. And if we look at this graphically, we see that. This is our housing market recovery index. I've been tracking this for the last couple months through the pandemic. And as you see here, we do see that dip in home sale activity. And it's not just that, we're measuring also demand, supply, price, time on market. These are what make up the index here that we've been relying about. Now, another story I've been seeing pop up is, are home prices going up too fast right now? You know, we're seeing appreciation at a level that is asking many to say, can we sustain this on the market? And so I want to take a look at that. And I want to talk just for a minute and give some data and insight to it. And again, using another quote here from Craig Lazara, this comes out of the Case-Shiller report that most recently was published. It says, housing prices were notably, and I'm tempted to say very strong in September. The National Composite Index gained 7% in appreciation relative to its level a year ago. 7% appreciation. Our 3 monthly readings since June of this year have all shown accelerating growth in home prices, and September's results are quite strong. Now, let's look back, okay? Because again, this is all about perspective. Most things are. If we look at compound annual home price appreciation going back all the way to 91, we see the average of 3.8%. Now, if we look back to 2012, we see a 6.1% jump in appreciation. So again, this is perspective. If we measure it relative to 91, a 3.8% to our now 7% jump, that's pretty dramatic. But again, looking back to 2012, a 6.1 to 7% jump, not as really dramatic. Okay, so again, perspective. Here's another bit of research I want to take a look at. Now, starting back in the year 2000, we've seen an average historic home value appreciation of 3.8%. An average of 3.8%. If you look at that as a graph, this is what it looks like, just like clockwork, an average of 3.8% every year increasing. Now, obviously, that's not what happened. Okay, this is what happened. Okay, this is what actually happened. We see we see the jump in home prices through the housing boom. We see the fall off as the housing crash settles in, and we see where we are today. Okay, and again, if you look at it, we are seeing home prices outpace that 3.8% average. Okay, just like in akin to 2003, 2004, 2005. But there's some reasoning behind this, all right? And there's a bigger story here happening, and it's the story of inventory. And we've talked about this before. As we see home prices increase, we've seen the inventory, the supply of houses decrease, all right? Now, this is basic economics 101, the inverse relationship of supply and demand. Lack of supply creates higher demand. But there are other things fueling this demand right now. Okay, we're seeing amazing interest rates. We're seeing rising equity. Okay, people's houses growing greater numbers in value. How about just the fact that people have been stuck at home for the last 9 months, wishing they were in a bigger and better house, more room to homeschool their kids in, more room to work from home in. Okay, now again, more perspective. This is Dr. Lawrence Yun, okay? He's the chief economist for the National Association of Realtors. I actually got to meet him 2 years ago at a conference in Nashville that was pretty cool. But here's what he has to say about it. Such a frenzy of activity reminiscent of 2006, raises questions about a bubble and the potential for a painful crash. It's on a lot of people's minds. The answer? There is no comparison. Back in 2006, dubious adjustable rate mortgages taxed many buyers' as budgets. Some loans didn't even require income documentation. And today, buyers are taking out 30-year fixed rate mortgages. 14 years ago, there were 3.8 million homes listed for sale, and home builders were putting up 2 million new units. Now, inventory is only at about 1.5 million homes, and home builders are underproducing relative to historical average. So, when we were back in the housing crash, that oversupply, okay, that I've talked about before, that oversupply was a huge factor. Today, we have the opposite problem. We have an undersupply, okay? We have different lending environments, okay? Completely different situation that we're in now versus the housing crash that finally hit home back around 2007, 2008. Now, another topic I want to talk about, another concern I'm hearing is, mortgage debt in the country soaring close to $10 trillion. Now, that's obviously a big number. And I have many people say to me, okay, here we go again. Prices are appreciating at an unsustainable rate. Mortgage debt is soaring. If we look back at the Federal Reserve, this is what the Fed has to say about it. Mortgage balances, the largest component of household debt, rose by 85 billion in the third quarter and sat at 9.86 trillion on September 30th. Mortgage originations, which include refinances, were at 1.05 trillion, the second highest volume in the history of the series and second only to the historic refinance boom of the third quarter of 2003. So as we start to see those refinances come in, we see volume come in, we're going to see more mortgage debt. That's going to happen. Now, it's important to remember that mortgage debt is going to rise as more homes are built and as those homes appreciate and more homes are sold. Okay. So, what we really want to look at is the debt service ratio. Okay. The debt service ratio is how much are people spending on servicing their debt relative to their disposable income. Okay. This is the graph that tracks that. All right. This is household debt service ratio for mortgages as a percentage of disposable personal income. All right. And if we look back all the way to 1980, we can see what that was back then. If we look at where we were at the height of the housing bubble in 2007, it was at a staggering 7.2%. Here's where we are today. Pretty manageable. This is very reassuring. Why is this? Well, it's two factors. One, it's lower interest rates. Talked about that before. And it's also rising wages. People are getting paid better. So what does all this mean going forward in 2021? What's that going to look like? Well, according to Jared Kelko, got another quote for y'all here. Above all, the 2021 outlook hinges on the course of the coronavirus. Shocker. Both the recent virus surge and the election make government agency relief more likely. He's talking about a stimulus package here. Okay, the likelihood of a stimulus package being passed in 21 is much more likely. Next year, we'll also start to show whether two big pandemic shifts will occur from services to goods and from in-office work to remote work. Even small shifts in these trends, if permanent, could cause big changes in how businesses hire, how job seekers search, where people live, and how much they earn. And one thing I want to talk about is that's real important here is mortgage rates. Freddie Mac just released their projections through the fourth quarter of next year, and it's very, very, very positive, very reassuring for our housing market. And what we're saying, right, is going to stay around 3% in 2021. And whether that's at 2.7, 2.8, just somewhere bouncing around there. And if we look at this bigger picture, like this graph shows, relative to other years, it is a much, much more favorable lender environment today. If you are looking to purchase a house, next year is going to be an amazing time to do it. And I want to talk to you about that. So if this next bit of quote is from Danielle Hale, and it talks about the volumes of homes sold. We expect sales in 21 to come in 7% above 2020 levels. She's predicting 7%, following a more following more normal seasonal trend and building momentum uh, through the spring and sustaining the pace in the second half of the year. While home sales are expected to lose some momentum over the last months of 2020, a shallower than normal seasonal slowdown creates a higher base of activity leading into 2021 that is roughly maintained for the first half of the year. As vaccines for the coronavirus become broadly available to the public and the economic growth reflects the resumption of a more normal pattern of consumer spending, home sales gain even more in the second half of the year. Now, let's talk about those home prices. Daniel Hale here is calling out 7%. I'm going to kind of back off of that a little bit. That seems to have the same amount of growth in 2021 as we saw in 2020 seems a little less than plausible. But looking at these two graphs, now I know it's confusing. It's just a 12-month graph versus a 2021 graph. These two, all of these metrics, they're comparing different points of data at different times of the year, but they both kind of show the same spread, anywhere from 6% down to 2%. I'm kind of calling this. I see about a 4% average increase in home values through the year 2021. So what does that mean for you? Well, it's a shifting landscape. Okay, we're not going to have as aggressive of home values spike as we did in 2020. I think a reason for that is going to be we're going to see more inventory on the market. I think some of the homes that are in forbearance, which I've talked about in other update videos, some of those homes are going to go on the market. All right, whether it's through, God forbid, foreclosures, people selling under distress. A lot of people have entered into that loan forbearance program that the government provided. And I think the squeeze is finally going to hit, and some of those people are going to end up having to sell their houses. So we're going to see more supply. And as a result, it's going to kind of ease the brakes on what home values are going to do in 2021. So I want to talk to you personally, each and every one of you, about it through the end of this year. And let's get a plan together. Let's see what 2021 does for you. So good luck to all you guys. I hope you've enjoyed this video. Merry Christmas, happy holidays to you, and God bless. And let's talk soon. Bye-bye.